Should the average person take on the risk and responsibilities of investing in financial markets without professional advice? The answer may depend whom one asks. Let's put the question to our studio guests. Welcome to both of you. And so you've been in the industry for some time, a lot of experience, and I know that if you ask an investment professional whether one should invest on one's own, the answer is always no. What's your feeling?
Well, I actually started out trying to do it myself, and then I went to a professional. Me, no. No, but let's start by being really clear. What are we trying to do? Are we trying to have fun? Are we trying to have a punt? Have a punt.
Points.
Go to the carousel. Go to Emperor's Palace. Identify what you want to lose, make that your target, and then go have a ball. But there's another whole element of investing, and that's investing as though your life depended on it. That's retirement fund investing, and your life does depend on it. And that is another ball game altogether. And I would never trust myself, as I used to be, to handle that. It's a far more complex problem.
Okay, so you don't trust yourself, are you saying because one doesn't have the skills or because emotions involved?
It's really a combination of many things. To survive in life, especially in a post-retirement, it's more than just investments. There are lots of things that you have to think about that are going to it's trade-offs. It's really about trade-offs. And that's the complex thing. That's the thing you can't do without some sort of models that says, if I do this, how will it impact this? And that's financial planning. That's a different ball game from investing.
So there are two layers of financial planning, and then within investing, presumably there are layers too. There's the asset allocation, and then within the categories, the selection there.
Well, it depends on, for example, if I say you have to solve certain problems in your life in terms of maintaining a consumption rate. And there are certain things that various different strategies will solve, and if investing you're targeting to solve one of those strategies, then you're absolutely right. Now you have to identify what's my time frame to solve that problem, how much money do I need to solve that problem, what's my probability of success, and then build the strategy around that goal. But if you don't have a goal, go to the casino.
So it sounds complex. What's your view?
I mean, I think Anne makes some very, very, very prudent observations here, and that's obviously having spent a very long period of time in the industry. But if you think about it, she's saying everything starts with an objective. What is it that you're trying to achieve? You know, it's with interest that I actually read the next issue of Finweek, and there was an individual that actually read this specific publication, and he said, well, you know, it all kind of points to the fact that you actually need an advisor, or you need people to help you. But quite frankly, I've been very successful at investing over quite a long, lengthy period of time. And he actually goes through the things that he has done and the things that he's done just to educate himself. And it's amazing to see the lengths that this man has gone to in order just to make sure that he could successfully invest his money. Now, we don't know from a yardstick perspective how good he's been at that, how appropriate those returns are. Absolutely. So we know none of those factors at this stage. But it certainly does point to one thing, that if you're going to be doing this on your own, it is doable. Understand what you're trying to achieve, and then be prepared to make the time commitment. And just here's a caveat quickly. The time commitment you need to make is not reading the internet. That's probably the worst thing that you could read. Kind of classic works in the investment field, things that people have done and have stayed and tried and tested, methodologies that people have looked at over the last 100 years. Those are the type of things that you should be doing over time.
The loser's game to start with.
Absolutely. Absolutely. And, you know, just to understand how markets and mechanics, how the mechanics actually work for the market. You know, I always hear people saying, and you'd probably attest to this as well, the market is a lot of science, but there's a huge amount of art as well involved in actual markets. And unfortunately, you know, when you're sitting in a bear market, Anne, you know, and the market is going south on you, you know, it's a professional investor that understands what to do. Whereas if you're doing it for yourself, that becomes quite difficult.
You know, you make a distinction of art and science. I wouldn't make it that way. I would say what's in your control and what's out of your control. And the scary thing about investing is the amount that's in your control is about that big compared to what you get. So all of this is what lands up on your plate that's out of your control. That you control. And that's the part that I think many investors don't realize. They pick an individual share, they think, I have insight into that share. They forget that probably only 30% of that share goes up and down as a function of that insight, and the rest is market or the factors that it holds in common with other
And I mean,
shares.
I suppose, and it becomes even more difficult once you start looking across various asset classes. Just look at the graph on your screen at the moment, and this graph here comes courtesy of Sanlam Investment Management, and it is contributed by Candice Payne, writing about knowing your asset allocation from your elbow. And there you can see the various asset classes. You can see them on the continuum over time there. Risks at the bottom, or risk or standard deviation or volatility at the bottom axis, and then a potential return on the other side. And this basically shows you how you should be contributing assets. The obviously net effect of all of this is obviously she's got some beautiful strategic asset allocations that she puts into her article.
I love her article. It's a great article.
Yeah,
it's a great way to start the DIY sort of process.
Yeah, absolutely. And this is one thing that kind of gets missed, I think, to a lot of investors, Erica, is the fact that they don't actually understand that managing money effectively isn't just about one asset class. Yeah. It's about a whole range of them.
There we go.
That's a danger. We tend to think it's all about equities because that's really where the fun and the buzz is.
But that's the difference between investing for fun and financial planning. Because what Candice is addressing in here is financial planning. And it's saying it's asset classes and the combination of asset classes that get you there. Yeah. Because if you only do equities, the volatility that's going to be associated with that is just going to be unbearable for any kind of long-term plan. So.
Yeah, I mean, I don't know if Anne can cast her mind back in time. Anne and I used to work together, and the body of research, we had a library, and the body of research around just asset allocation and what is prudent and what is not prudent on asset allocation literally filled half the library.
Let me challenge you on that. So the basic premise of your discussion now has been go to the experts. Now, you've spoken about asset allocation. All the empirical research says that anything from 90% to over 100% of your ultimate performance or the variability of that depends on your asset allocation. If you go back to what financial advisors in South Africa are doing, there are many accusations afoot that the advice that they're giving to their clients are hopeless. They're not taking enough risk, they're moving too slowly, they're way behind the curve. So you're suggesting we need to go to the professionals, but are we getting good advice?
No, I understand what you're doing here. You're not going to go to a professional because they're smarter than you. And because this isn't a game that's won by people being smarter. This is a game that's won by people keeping a focus, and you focused on what you're trying to achieve. So you go to the professional to almost be your babysitter, to be the person that keeps reminding you what you're trying to do. Now, if you think you've got that kind of self-control, go for it. But most of us human beings don't. And we need a constant reminder, and there are two things that I want out of a financial planner. Control me, keep me focused, and help me understand what my trade-offs are. I keep going back to the trade-off things because we forget that. We forget that if I take my money out of my Provident Fund, cash it in so I can pay off my debts, what does that actually mean to me later on when I may have less debt, but I still have a burden? Is that a worthy trade-off? I don't know.
Could be.
So. Yeah, and I mean, that for me, that extends from that all the way into how we actually treat investments and how we think about investments. Just look at the graph, and this graph here comes from Adrian Saville, and he writes an article in here called Start by Getting Off Your Rocking Horse. He shows the NASDAQ Composite Index. Remember, this is a tech-heavy index in the United States. And what he shows is he shows you the run-up in the NASDAQ, and he shows you right at the top in March 2000, 53 billion, which is the largest ever inflow into the NASDAQ. And then as the market corrects itself right at the bottom end, guess what? Well, 49 billion out, effectively 5 times March 2000. And that just kind of shows you we are sometimes our own worst enemy. We sometimes do things that are completely contrary to what we should be doing. Now, if you're a self-do investor, have you got those kind of principles in place so that you can save yourself from a situation such as this? Do we have those? Do we understand those? And then more importantly, once there's a return from that, how does that relate to your whole financial life? How does that relate to your objectives? How does that relate to planning and everything else? And therefore, I want to concur with what Anne said just now. It's about keeping focus, which is, I think, the most important thing here.
I mean, there's a wonderful Dilbert cartoon where the Dogbert gives the guy a bill for, what is it, something like $1 million for his advisory fee. And he says, okay, I got $1 million for what was it that you did for me last year? Wasn't that nothing? And he said, you don't know how much intelligence is required to know when to do nothing. And that's the most brilliant statement on the planet, you know, in terms of investing. When do you do nothing?
So how do you choose that brilliant person? What are the warning bells, signs that you should be avoiding that advisor and going elsewhere?
If he sits there and sells me on return.
Yes.
I mean, absolutely.
It goes back to a point about trade-offs, right? To get more return, you take on more risk.
I mean, I sit with asset managers all the time, and guys say to me, my returns are brilliant. You must see how fantastic my returns are. We have achieved X in a market that has done Y, or we have beat this, or we've beaten that. And I say, you know, that is fantastic. I said, you guys have worked really hard at creating that return, but what does it mean?
Anybody who sells return, run for the door.
Is it about processes and systems?
It's about process, it's about systems, it's a guy who understands what it means to be a fiduciary, someone who is responsible for someone else's money.
And dare we say, and I mean, this is the one horse we've always been on, and is the independence horse. Is that maybe something worthwhile, maybe also mentioning?
Well, what does independence mean? It just means, how does the guy make his money?
Yeah,
where does his commission come from?
Yeah, where does the commission come from? You know,
there's a whole trend underway, I think, globally, where financial planners are actually being asked to charge a fee for financial planning. And then should there be implementation, there's a very specific role that they have to play in implementation down the line. Now, I'm seeing investors becoming a lot more astute about what it is that they need, how they need it, and then who they're going to be going to for that specific advice. And there's a whole range of options that have opened. And I think the DIY space has opened more of those options. So you could very well go to a financial planner, get a plan, and still do the investing yourself. Caveat, obviously, is you are sometimes your own worst enemy. Do you understand what to do and what not to do?
So the plan gives you the framework, the asset allocation, within that a bit more control, whereas you have the fun of the implementation and also learning by doing.
If you're going to be picking individual shares, you're not investing for a particular target. That's a different thing. That's just that is punting. And I don't say that disparagingly. I love punting, or loved.
Before you became an institutional, serious person.
But you can, as Kubi says, it's the asset classes that get you to a particular financial goal. And so you have to build portfolios that capture what that aspect of that asset class is. And that has to be a relatively diversified portfolio. It's not for nothing that we have professionals running diversified funds. They're capturing a particular characteristic. And that's what you want to do for financial planning.
So Kubi, is that not the danger, that we get fixated on equity and possibly physical property and maybe a tiny bit of cash and nothing else?
Yeah, absolutely. I mean, let me also say that let's assume you are a young person today. Let me start off by saying that I've seen tons of young people that become older individuals that have just successfully been in equities for very, very long periods of time and then just continue to do so. They've kind of built this relationship with the market. They understand the businesses they're in. They've always invested in them, and it's compounded over time. They understand diversification, and time has allowed them to compound out over very long periods of time. There is a happy relationship with an equity market, and I love those portfolios because when you stand with them, they actually tell a story. But for the majority of investors, that is not necessarily the case. They're sitting with a pool of money at retirement, and they're saying, what am I going to do now? And the first thing they ask is, I want to pay an appropriate fee. And absolutely, there's an appropriate fee to pay for these things. But then the more important thing is, are you getting a decent level of advice? And if you're going to be doing it yourself, do you actually understand what you're going to be doing? Just to give an indication, any decent asset manager will be turning over their portfolio at least every 5 years once. That's very little trading. That has very little to do with punting. There's a lot to do with setting the general direction for a fund and ensuring that you understand how you're going to relate to objectives over time. But the first thing that we do as investors is we try and do the hot thing in our portfolio. We try and say, what's cool to buy today, which really has very little to do with it. Just look quickly at the graph on your screen. Again, this comes from the article written by Cannon, Start by Getting Off Your Rocking Horse. It shows, and it's again something that we've spoken about so many times on the show, it shows the actual quarterly rand-dollar exchange and how that has changed over time. And then it shows you the various other lines that you see kind of running and jotting out. Those are the predictions from various analysts. And again, this is the most important thing. If you're going to be looking at predictions, this is clearly one of the worst ways you could actually make a decision.
That's what she said. But maybe the point that has to be made is that you don't go to a financial planner for investments.
Yes.
You go to a financial planner to solve financial planning solutions. Problems. That's where the conversation is getting confused.
Yeah, I mean, I'd concur with that. You know, people, if you look at financial planning and you say, I'm here for investment excellence, you're there to get a broader understanding of all your assets and how those actually relate. Very, very importantly.
Well, This has been very insightful, and I think just to remind viewers that an in-detail discussion, the discussion that you refer to, is available in this magazine, Collective Insight, and the details are also available on the website. Gubby, you're passionate about this. Give us the details.
Yeah, absolutely. I mean, if you go to the ABN Digital website, you go right to the top, there's a little, and it's actually at abndigital.com. You click on blogs right at the top end of the screen, you'll see the WealthQuest forum coming up, and this is the landing page of the WealthQuest forum. You'll see a little bit about, at the top end of the fund, of what we do on the website. There's a blogging area on the left-hand side, and then you'll see on the right-hand side of the screen, you'll see papers and program material. And let me just enlarge that quickly for you. Papers and program material, you'll see right at the top, you'll see Collective Insight Winter 2012, and this is where you could find this publication. That's the one that actually appeared in Finweek, and that is what we are looking at this week. If I go a little bit down, you'll see there's also some articles from Roland Trousseau, articles from me, and papers that I've presented at the top end of the screen. And you want to go and see some data, there's an SA data set as well available. Want to go see a decade worth of data in South Africa? That's also available.
And just a final comment from you on this issue. Do you think this gives us a balanced perspective? What do you think will be the typical reader response to DIY investing, having read this?
I think it'll make a distinction in their mind as to what they're doing. And to understand investing is one thing, financial planning is another, and never the twain should be confused. And I think that's the most important thing that you get out of this. So financial planners, you have to get some help. Investing, have fun. Go to the casino.
Careful, what would you say?